The product name is called USD.AI, and it's a yield-bearing synthetic dollar, which gets its yield from DePIN hardware loans, effectively. We don't like counterparties or businesses because it takes forever to get your money back. Anybody that had their money in FTX understands. The best thing about DeFi is that it reduces the cost of structuring interesting derivative or interesting yield products.
Hello, everyone, and welcome back to the Unleashing DePIN Podcast. My name is Tyler. I'm your host, and I'm quite excited for the next guest we get to have on the pod. He is someone building in kind of an interesting space, the next evolution of DePIN, if you maybe want to call it that. We have David. He is the co-founder of USD.AI. David, how are you doing? Welcome to the Unleashing DePIN Pod.
Thanks, Tyler. I'm excited to be here. I'm doing great. It's an interesting market, but at these times, it's when the more interesting products are built.
Yes, couldn't agree more. This is certainly interesting times. At the point of recording, we are in the midst of all the crazy tariff conversations, which is certainly driving a lot of the narrative, but we'll put that on pause for a quick sec. Maybe before we jump in, I'm super fascinated about what you're building. I think it's really the next evolution of kind of bringing in a lot of the traditional financial relationships we have in existing markets into DePIN. So I think that's really fantastic that you're forging that space. But I'd love to start with just a quick introduction. Let everybody know who you are, maybe your background, how you found yourself here, and then we can get into it from there.
For sure. Yeah, happy to jump into kind of my path and finding the space. My career started doing art lending. So I actually used to give loans against artworks. After that, I worked in investment banking, doing the usual stint. That was like in real estate, gaming, lodging, leisure. So like casinos, all the way to real estate assets and stuff like that at Deutsche. A lot of ex-Deutsche people in crypto because I don't think a lot of them like their jobs. So kind of like the Delphi guys. And yeah, I've been in the space doing kind of proto MEV in the early days. They didn't call it MEV back then. It was just gas bombing or like trending into ICOs. Been venture investing ever since. And yeah, did a hackathon like in 21 and turned that into a protocol, which was really focusing originally on illiquid asset types. So things that like just didn't have that much spot liquidity. And most of DeFi, as we know, is really focused on high mark to market, like things that are priced very frequently, like microseconds. And that's why oracles exist as like a core primitive in DeFi. And we just looked at things that were just less liquid because usually in finance there's a phrase like the better price of an asset, there's less alpha to generate. Because if everybody knows the price, what are you really making? So things that are like low liquidity, where my traditional experience comes from, things just are harder to price. Businesses are harder to price. Assets are harder to price. Real estate, equipment, stuff like that. That's why we call it the capital markets, because they focus on being useful. And yeah, so we built all these primitives in DeFi, really focusing on things that are oracleless in a sense, which just means traditional like underwriting. And we looked at the entire football field of asset classes that were not ERC20s effectively. It's the 721s, PFPs, all the way to GameFi assets, when axes really were like the first time you've seen like productive capital on chain. And we went down that ladder of what's actually generating cash flows, nodes, all the way to eventually DePIN. And for the last 8 months, we launched a mining corp called Tactical Compute, which was a 40 mil like mining corp with the Merit Circle or Beam guys as well as Aether. That kind of taught us more about the AI mining space. And that kind of brought us to where we are today, which is a culmination of all these efforts with MetaStreet, which is the initiative I was talking about before, Tactical Compute, and now USD.AI.
Very exciting. Maybe you can give a high-level overview of exactly what you're building on the protocol side, and then I'd love to really unpack how you evaluated DePIN as being kind of the next target for applying a lot of these primitives that you're developing at USD.AI. Can you maybe give just an overview of exactly what it is that your product is solving?
Yeah, the product name is called USD.AI, so www.usd.ai. And it's a yield-bearing synthetic dollar, which gets its yield from DePIN hardware loans, effectively. And it abstracts a lot of the processes of the underwriting, the origination, and turns it into a very single, like staked USD.AI and USD.AI. That's two tokens, very similar to many other like synthetic dollar products that exist out there. But it effectively generates yield from DePIN collateral. That is, a lot of it sits off-chain, which is typically the hardware side. And the process goes that we effectively try to find major operators in various DePIN protocols, as well as like traditional like hardware operators, like if they own like GPUs and stuff. We don't actually do the loans against the business. We do it against the hardware only. And there's a good reason for that, which I'll get to in a minute. But the main idea is that like you have to be as trustless as possible with these kind of structures. We really don't like SPVs. We don't like counterparties or businesses because it takes forever to get your money back. Anybody that had their money in FTX understands.
Yep.
And that was kind of like the synthesis of the idea. Like we built the primitive of dealing with low liquidity assets, which is kind of like hardware, right? That's not traded very often. There's no clear pricing of it. and how to abstract that into effectively like a soft high yield bond index kind of product, but with also a fast path to liquidity, which is why we designed it like a synthetic dollar as opposed to just a straight up bond like product.
That's really interesting. And maybe one of the things that's helpful for people to understand is that the approach that you're taking with kind of the synthetic dollar is done in a way that skirts around what would otherwise be maybe more akin to an approach that violates securities laws. I know that's somewhat related to your architectural decision. Can you maybe unpack that for people that don't necessarily understand the nuances and how what you're doing is able to increase the velocity of capital within these different networks, but doing it in a way that's also compliant?
Yeah. And this is, I guess, this might be interpreted as a criticism about the RWA industry. But RWAs can be divided into really two things. One is like an actual hard asset that's being represented on chain, and then a security, like a tokenized security that's represented on chain. If you bring a treasury bill product and you represent it on chain, you're really re-tokenizing a security that's already been structured off chain. I think that's certainly neat. Like T-bills especially is quite useful for this specific kind of product. But if you're doing the securitization like stuff off chain, like then you're using the legal rails there. But the best thing about DeFi is that it reduces the cost of structuring interesting derivative or interesting yield products. I wouldn't call them securities on chain. I would just call them like yield products. And doing that at zero cost, at the cost of gas, which is why we have liquid staking tokens. That's why we have synthetic dollar kind of products. Like that is stuff that isn't a security, but uses hard assets. So the real question for that RWA, true RWA non-securities kind of product is that it just has to actually represent the underlying asset one-to-one. So if there is, and the IRS and many authorities have said like an NFT asset can indeed represent an underlying asset, whether it's a trading card all the way to arts and collectibles, and also real things like real estate, or like in this case, equipment. And once you do that and have that absolute certainty that underlying asset, and in this case, hardware, and that's why we only give loans against hardware, are like we structure liquidity products against this one-to-one asset and not to businesses, is because we have pretty high absolute certainty that it really represents the underlying asset. That's the first step and probably one of the most important things we've learned. And this is actually why we bought GPUs ourselves, like H100s under this mining corp, as well as our own, and they just to figure out like us actually going to data centers and actually installing with something called smart hands and trying to see what the actual process is and getting your hands dirty to learn that process. And it's only through this method you could really understand the collateral type and how to break that supply chain of representation.
Sure.
But yeah.
Yeah, that's really interesting. Can you maybe unpack a little bit about how the actual process works? So you put up collateral for what is hardware, maybe that's new hardware deployments or hardware that's already been set up.
Yeah.
And then what's the kind of the A to Z process there for people that are either borrowing funds to acquire the hardware? What's your role in that? Can you just give some details on that front?
Yeah, we have an acronym for this actually. We call it a Caliber. So it's a collateralized asset ledger, that's CAL, insurance, bailment, evaluation, and redemption, which is just a lot of checks and balances to really make sure that the underlying asset, even in the event of catastrophic events, it's always going to have the economic value that you really originally represented on chain. In that sense, it's like, hey, what if somebody steals it? That's the most common question we get. I'm like, that's why it's insured. And secondly, do you really own it, or is it held in an SPV or something? We use something where they effectively do a sale leaseback, which is that they sell it to us, and then we do a bailment with underlying asset. It's a rather unique structure that we pioneer with our legal team. But in any case, like it's not really under their ownership in the event of default. So if they run away with underlying asset, they can't because they'll go to the location where they want to physically redeem the underlying asset. We have a lien against the underlying asset following UCC Section 7, like all these other traditional rails, like the electric title document and all these levels of guarantees that the underlying assets is in fact under our name. So if they try to take it, then that's theft, and that would actually trigger insurance, which would mean that you just have a claim for that insurance value. So at the end of the day, like no matter what, like it becomes a very simple problem. It's not actually the financial engineering side, which is in of itself like a very different problem. It's like, how do you actually represent one-to-one of an underlying asset? I've seen so many RWA platforms just say, yes, an SPV. I'm like, SPV? Like, that it just like, that makes no sense to me. What are my certainties, guarantees? They're like, that's audited. I'm like, that doesn't still mean like I have the rights to underlying asset. It's just multiple vehicles of really representing an underlying asset. So we actually built this out of need. We wish somebody else like actually create these standards to make it to that caliber of us giving actual derivatives off these underlying assets, and we just haven't come across that. So It was more like we had to build this out of our own needs.
Yeah.
Yeah.
That's huge. So if I was a company that has, let's say I'm setting up a $10 million data center and I want to put up a bunch of hardware, how would the process work for me to come and leverage USD.AI to maybe help fund some of that hardware to
Yeah.
collateralize it with a loan? How does that part of it kind of work on the deployer side?
As of now, we typically wouldn't want to, at the moment of purchase, they might have to find some PO like financing to get it to the data center. But we wouldn't do it unless it gets to like a place where a third party can verify it. And we have third parties that do like site visits to make sure that it's actually installed in the location. And then you go down the list, like this laundry list of stuff that actually verifies it's there, from burglar alarms to fire, like insurance, stuff like that. So it's quite serious. And then if it's actually represented in an underlying location, that's when it starts to qualify for insurance. So it has to be installed in the specific case of GPUs. It differs depending on the collateral type. And so that's why our protocol has modular underwriting. But once they have it installed in a certain location, we can tokenize it because we'll be able to do this sale lease back all the way to bailment with this guarantee because the moment it's tokenized as an NFT back to the holder in the event that they give us the ownership, then we can insure it, which means that the underlying asset will always have the economic value. So that process is just I'm showing you all the back end side of what actually happens, but to them, they just see a single button, which is, oh, I just signed this contract and I got this NFT, which represents an underlying asset. We do not run cash flows through the NFT. That's one thing we don't do. We also don't fractionalize the NFTs. Those are two things we are absolutely quite confident that we're not comfortable with, just why we don't design it that way for security law issues. Because no, apple tree and a hill metaphor. You can't actually represent this NFT as a different economic, like it's fractionalized all the way to cash flow based underlying assets. It's just the right to redeem should you actually want to. That one-to-one representation that's compliant, that doesn't break any gray area territories, is the first step. So once they do that, once you have this NFT that you absolutely are pretty confident is representing what you actually own, and now you're operating it in this moment, then you can do anything you want with it. The thing is, a lot of these DePIN protocols actually are doing this without like our guidance. They were already tokenizing as NFTs, right?
Sure.
What can you do with NFT in DeFi? One protocol. The answer would be like Blur. All right, are you really going to list it on Blur? Is that the use case? People are like, oh, we'll just do some Pendle thing. I'm like, you think you can take an NFT to Pendle right now? Do you think you take an NFT to Uniswap right now or to Aave? Yeah. Nobody has actually dealt with this besides a small niche of these guys who were trying to solve the NFT liquidity issue, which by happenstance we were trying to deal with these issue types. So when people want to bring RWAs to crypto and say that we have all these use cases, I'm like, for one, most of your RWAs, unless they're securities, can't be used for anything in DeFi. In this case, anything in DePIN that when you bring DeFi, like what can you really do besides the token itself? If you have the hardware and it's an NFT and cash flows running through a SIFI, you have this NFT that is unpluggable to anywhere. And that's why we built Metasphere originally, the protocol, which is like an Oracle lending protocol that can actually intake these collateral types. Yeah, I can get to that in a minute of like how we structure the debt and the yield. So it's abstracted into a single yield-bearing token. But dealing with these stepwise problems of like even the RWA side, yeah, it's at the end of the day, it's going to be an NFT.
Yeah. Yeah, no, absolutely. I think this is a good segue into the next kind of part of what you were chatting about, because what's really interesting about what you're building is that you're effectively building kind of a derivatives market on chain, leveraging these different assets. So how does the actual yield calculation or kind of participation from other people happen, show up, and is represented on the protocol side? Can you share some of those details for us?
For sure. Yeah, I guess we can now shift it over away from the borrower and now toward this yield fund. And the yield fund, they're used to a very specific format, and that this yield-bearing token has to be an ERC20 or like a fungible token if it's on Solana or any other platform. They're used to like a synthetic dollar kind of product, something that you can plug into Pendle, I like to say. So if you want PT DePIN yields, it's like the fast way to visualize it. You have to go through this abstraction process of physical real-world asset into an NFT, and the NFT into a yield-bearing asset, and that yield-bearing asset being abstracted into a synthetic dollar kind of product, which can finally be LP'd on Uniswap. So you have these multiple steps of structured finance, which is our team background, of taking something very ugly, all the way, you can even call it a tractor, right? Tractor is the most common thing we talk about in economics is, hey, what's the economics of a tractor? Yeah. In this case, it's not that. A tractor is in fact a robot, which is in fact just DePIN, right? That's all it's the same problem. And somehow taking that into a yield-bearing instrument, and that's a bond, right? That's kind of like what all these synthetic dollar products pseudo-represent in a sense. And the depositor that just deposits on our platform, they just mint USD.AI and then they stake USD.AI. The moment they stake it, that's when they are starting to do real infrastructure loans. Normal USD.AI is just T-bills. That's just to make stale capital productive. So you have USDT, convert into USD.AI. You can always withdraw it because it's just T-bills. We use M0 for that. And then you stake the T-bills to then give liquidity to these borrowers on that side, right? You have this NFT, and then this protocol also gives you a loan against the deposits. So what happens is you can have an infinite amount of lenders, and you can have very diversified borrowers, and that's abstracted through this single platform.
Interesting. And from the yield kind of calculation, is it safe to assume that it's whatever a coupon payment would be for a bond, like that's equivalent roughly to the yield, or is it you're looking at something more like a collateralized debt obligation where it's an aggregation of different debt instruments, and so the yield is maybe some risk percentile based on the credit scoring of the underlying asset base? Help me understand that part of it.
A lot of the loans that we do are pretty bespoke just to kick off the market. Eventually, it'll be a little more market driven. It is market driven in the sense that we have these vault underwriters, which can originate the underlying loans. They're also the first loss in these loan structures that we have. And the nuances is that like these underwriters of the vault lose money first before the USD.AI providers. This is like in the very middle of our design of borrower and lender. You have the vault underwriter. Fixed income is quite difficult in that it's not going to be a single, like we call it P controllers, which is just like a single input like utilization that dictates the yield, like on Aave. For us, because it's fixed income as opposed to floating, like you enter and exit like an open-ended fund, where it's like a king curve, they call it, in terms of how utilization completely ties into an output interest rate. For us, it's not that easy. It's going to be like, hey, the market is like, hey, we're going to start up pretty high. And if you go down from that, oh, you're starting at 50% APR. Nobody takes a loan. I'm like, all right, we can't offer 50% because nobody's going to take it. So you really end up in this market rate, which is what the vault specialists can understand is, it should be like probably at least 15 as a hurdle rate, targeting 25 if they would accept that, if the risk is that high. And it's all parameterization. The nice thing is that I would say 90% of the risk is abstracted because we own the hardware.
Right.
The hard part is now, like, what is the amortization schedule for that specific hardware? And those layers of defenses support that. The fact that they actually put their own money as a vault underwriter does also help with putting money where the mouth is and protocol defense.
Yeah, no, that certainly helps clarify things. And then in the case where you mentioned like a fixed income versus, or you have hardware where utilization is somewhat relevant to the actual cash flow. I understand there's like a disconnect between the two.
Yeah.
How are you thinking about assets where the value that might be able to help with the repayment is based on a fluctuating utilization rate? Just like high level, what's your kind of general take on how that's going to flow in the future?
We certainly look at the utilization, which we just proxy through cash flows. So rental rates for pieces is a good proxy. Number of customers in a certain area for tenants is a good proxy. But as a credit position, instead of the guys who are actually operating the business and the utilization is their problem, fortunately, we don't underwrite businesses. We underwrite hardware. So we really underwrite like what the average entire market like rates are, because we know in the worst case scenario, should they default and the underlying asset goes to auction, the buyer of the underlying hardware will look at the hardware value. They won't look at the business because we're not giving loans against businesses. And that's why we have a very specific design toward, we're really giving loans against hardware NFTs at the end of the day, which is why we can absorb a closer to a synthetic dollar position rather than a pure bond structure. If you're doing loans against businesses, you can't be a synthetic dollar. Generally don't believe so. I think unless there's, because of the liquidity issues, if people can innovate on that, maybe. So I'll take that back actually. I know some people are experimenting with it, so I won't be decisive on that comment. But usually a synthetic dollar requires, one, how is the yield generated and distributed? And then two, how is it peg maintained? And we have our own structure for that. But like the latter one's most important because you can have blue chip hardware or blue chip collateral, but it could still be toxic if it's structured incorrectly. And the moment you lose that peg, or the moment you can't get back to peg continuously in a structured way, then you don't have any more deposits.
Yeah, that's super interesting. I get that DePIN's a fairly nascent space, and so there's probably not a lot of players out there. But in a future world where you do have lots and lots of different companies, how are you envisioning different types of pools that are tranched across maybe verticals or project hardware types?
Yeah.
How do you see kind of the innovations around that specific derivative market growing as DePIN expands and you have more adoption?
Yeah, my favorite example is the largest energy DePIN token called Bitcoin. That is the largest equipment financing that's related to crypto. It's about estimates is 25 to 50 billion, which is almost as big as DeFi in of itself. The reason it's
Mm,
not DeFi because they went from CPU to GPU to ASICs in 2014, and then that actually did change the economics of Bitcoin mining economics quite a bit. Bitcoin mining is probably the worst, the absolute worst kind of loans you can ever give. It literally is fully amortized after 18 months. Like it's terrible assets, right? The new ant miners come in and then like the last years is just suddenly worth nothing. Like people are optimizing even the shipping times, right? Because it's so sensitive. All the way to it's tied to a single currency, right? Every single Bitcoin miner in the world is now becoming a GPU miner like CoreWeave. CoreWeave was ETH miner turned to
yeah,
GPUs, and that's because Bitcoin mining is so hard. But
yeah,
still, it's 25 to $50 billion of debt. That's how much TradFi likes equipment financing. That's insane. They did innovate on like the convertible debt structures. That's really a MicroStrategy. It became MicroStrategy because of Bitcoin's heavy use of convertible debt. They improved on it a little bit. But the three categories that we look at is better. Pretty much any category is going to be better than Bitcoin mining, I like to say, because it's just like really the worst hardware we could ever have. We have energy, telecom, and compute, which I think are all related to the AI like hardware stack, which is why we're called USD.AI. And then I think a lot of DePIN at the end of the day is really catering in the future toward the AI hardware stack, because soon to me, like AI is no different from internet or like just Web 2, Web 3 is all going to be AI. And those are the three categories we look at. We're considering a fourth for robotics, but I think we're a little far from that. But frankly, like a robot in a factory is no different from a GPU in a data center. Like it's like a third party isolated asset. It's generating cash flows. I'm a cash flow guy, and I just look at that and I'm like, what's the difference? It's all the same to me. If there's a secondary
yeah.
market, if there's cash flows, and if it's a DePIN network, which DePIN to me is the answer to the utilization problem, in that it is kind of like play to earn, but for like hardware. I like to
Yeah,
say nobody likes me saying that, but frankly, that's what Bitcoin mining was.
it's a good
Like,
analogy.
why would you solve random math problems for no reason? No, it's just get a token. But the three vaults we have for that, and that's how we like modularized underwriting, is that we have three core vaults, which is compute, telecom, and energy. And then from there, you have underwriters for each of those specific vaults. We'll probably leave compute just because that's the easiest collateral type, but we're definitely doing some pretty interesting POCs on other verticals. And then you also have to underwrite the specific hardwares. The benefit is that hardware is somewhat like semi-fungible. It's kind of like the
Mm,
floors of NFTs. That's where a lot of the volume happens anyways. It's like they're mostly somewhat fungible between each other. They're not truly like one of ones, like real estate assets. Even real estate is semi-fungible in a sense, but it's not like art or something like that. So that does help with the underwriting scale as well. And then the fact that we have this caliber like structure also helps decrease the risk significantly. So it becomes like a very scalable collateral type that becomes, it's not illiquid, I like to say. I like to call it semi liquid, because this stuff can clear the market. Like you can sell like hundreds of millions of this stuff like over a week easily. But yeah.
yeah, that's super fascinating. Given the different underwriting requirements, do you foresee going to the project specifically as kind of the first base and then working with either deployers at a large scale or people that actually want to acquire the hardware as your initial kind of go-to-market rollout? Or is it something that you can just evaluate hardware on a one-to-one basis for the underwriting criteria and let them come onto the protocol that way?
Yeah, in the beginning, there's going to be a bit of a ramp up period. Or like one of the core like KPIs that we have internally is like, how do we shorten the period of origination, first contact to borrow? Like, how fast can that be done? We're hoping that one day is instantaneous. In the beginning, it will require some levels of on ramp and onboarding, which is frankly just the nature of a physical world. But yeah, I mean, it's a lot of the steps in the beginning starts with a proof of concept before you fully expand. It helps with the governance as well because people get comfortable with collateral. It's a feature, not a bug, in my opinion. It's just if you're dealing with an asset type, what one benefit we have in crypto, and I say this out of true confidence, is that people in crypto are actually one very smart. People think retail depositors don't care what they're depositing. I'm like they do because they've only lost money for the last 4 years since
Yeah.
21. So they know the ones that are here are very smart. And two, they are actually quite sensitive to the collateral type. And they're most people in crypto are very comfortable with mining. They're not comfortable with real estate loans. They're not really
Right.
comfortable with business loans. If you say like AAA, like blue chip, whatever, and it's like some corporate bond that sounds good to the TradFi guy, they're actually not that comfortable with that because they're like, I don't understand why this makes money. Oh yeah, it's like some car loan thing. It doesn't even have to be like a Africa fintech middleman loan, which some platforms have done. It could be like even a corporate bond. They're like, I don't know if I should get yield, like 11% yield on this, but if they get 15% yield on crypto mining hardware, suddenly they're very comfortable with that type of collateral. So yeah, that's interesting behavior we've noticed.
Yeah, that is certainly interesting. I concur with your assessment on that. I've also heard you use the term protocol-owned compute. Can you maybe share a little bit about what that means to you, or maybe what that should mean to other people? Is there just kind of thinking through all the financial implications or intersections between this new world of DePIN?
Absolutely. One of the things that I've noticed in a lot of this decentralized training, decentralized GPU marketplaces, is that nobody answers the question is who actually owns the hardware. They just assume there's a lot of this is especially for edge computing. It might be something where like everybody owns like a consumer level grade like hardware. I've actually talked to a few of these protocols and they're actually planning to put like 20,000 of these in the data center. I'm like, is that really consumer anymore? Not really.
Yeah.
They're just trying to optimize for the game. But like at the end of the day, like we're probably going to use high quality hardware. Otherwise, it becomes very, very unproductive. I've seen this behavior in DePIN where as the cheaper the hardware you put to the audience, yes, you get scale, you get the numbers maybe to get listed or something, but the quality and data fidelity and this is why we use H100s, right? Or instead of using consumer grade hardware for AI, it's that expensive hardware is expensive for a reason.
Yeah.
So when people have this dream of decentralized training, are they talking about 4090s, 5090s in the future? Probably not. They're probably thinking about decentralized H100s. And so the question still stands is each of these things are like 30K, right? Who can afford that? And that question of ownership is a very different question of rental. It's kind of like Fannie Mae, the Fannie Mae's business, which very few people understand, versus the Airbnb business.
Yeah.
Like, how do you actually enable ownership? And you enable ownership in the US through the proxy of interest rates and like how weighted average cost of capital works with regards to ownership of a house. It's very expensive to buy a house with all equity. It's very cheap to buy it with 2% debt. Just conceptually, like how much do I pay a month? That's really how we think instantly. What is my mortgage rate? So when it comes to what is the interest rate of DePIN as ownership layer, of bringing compute to be owned by blockchain-based organizations, this is only possible if you have a debt layer. We solved the revenue layer with DePIN. We're solving the debt layer with InfraFi. And then this next evolution, which we think is going to be after us, like we ourselves, I don't think I can take claim to protocol compute as a business. That's come more like an OHM style business, more about governance than it is about the economics. I believe that can be really the end goal of what we're trying to create. It's like, what is the goal of us creating all this? Well, eventually you have on-chain organizations that become greater entities than CoreWeave. Decentralized compute, decentralized training, and all requires a decentralized capital stack. Yeah, that was the thinking of what is the end goal was protocol compute. If AI is, it's funny because Truth Terminal, what was the first, why did he ask for that 50K from Mark Andreessen? It's so he can live forever, right? He wanted that grant to have compute. And I'm like, if AGI is real, it will optimize for a controlling the interest rate of the debt against their hardware because that is the mortal sink of its existence. Kind of like the petrodollar. It's like, why did the US go to war? Not to be political. Why do they care about the Middle East? Oh, it's because of the oil, right? And oil is the primary driver of growth. And if AI is the primary driver of growth, how do you control AI? And it's going to be through compute, and compute's controlled by the capital stack. So protocol compute to me is like the holy grail. It's just like, that is why Web3 matters in the future of AI. That's why NVIDIA will care about AI, because it is the strongest capital formation structure in recent technology. And Stargate's certainly nice, but I think that should be on chain. And that's going to be not done through by subsidizing it through dollars by government issuance. It's going to be from proper economics of crypto economics.
Yeah. Super fascinating. I just love hearing all the things that you're thinking about. You're right. Like this is certainly on trend with where the world's going with respect to these decentralized compute resources or just other decentralized infra that kind of spans across DePIN. What else is next on your guys' roadmap in terms of either protocol developments, other productization things that you're going to be building out? What can folks stay excited about?
I think for us, it's the most obvious thing is that we are going to launch pretty soon in terms of USD.AI. We're not at launch product yet. We're still in the auditing phase right now. We just entered testnet as of this call and still developing a few other mechanisms. One of the cool mechanisms that we created was queue extractable value, which is turning the redemption queue into a market. And that's how we like maintain, or that's like the primary arbitrage venue for the peg to be repegged. We don't necessarily force a peg. We create venues to repeg. That's like the better heuristic, in my opinion, of a synthetic dollar, and working with some DeFi collaborators on pricing that risk. But that's not coming out with the launch. That's probably going to be a few months after. But we're iterating on the product side quite a bit to make this all possible. As for then that's for really the minters of the USD.AI. So you can eventually LP on Pendle and eventually Uniswap and a few others. For the DePIN side, what excites me is that we're having conversations with a few DePIN protocols. And the DePIN protocols, there's a nice Masar report, I think with Robert from 1KX. They did a post. The more expensive a hardware is, the more that protocols have to pay in rewards to get over that hurdle of adoption.
Yeah.
They have to pay like 100, 200% APR a year. They don't call that in DePIN. They call it payback period, right?
Yeah.
Yeah, it's a 6-month payback period. And I'm like, that's 200% APR. That's wild. That's like massive. The charts are always going to be Hitler down, right?
Yeah.
It's like, so they're going to dump because you have to compensate for growth.
It's unsustainable.
Very unsustainable. This has actually happened to Bitcoin in 2014. It's a hidden history. Like Bitcoin miners suddenly had debt. So miners no longer need to sell Bitcoin to compensate for their growth. They just borrowed more. And suddenly Bitcoin price stopped going super down every time a Bitcoin was mined. And that changed the economics of a lot of Bitcoin itself. So I'm thinking like, why don't you do the same history with DePIN where like maybe DePIN protocols can change their entire tokenomics to not compensate for the economics of 100% equity purchased hardware, because at the end of the day, it's all cash-based purchasing, right? Maybe you can now change the economics to cater to the interest rate of controlling growth. If inflation's high, the Fed does one thing. They raise rates. Like that's the only lever they really have. That's talk about fiscal and all, but really it's just monetary policy. So what is the monetary policy of these DePIN nations? They don't have a lever until maybe we come into the picture.
I think that's so important. One of the things that I've been writing on the background as a new research report around specifically this challenge of inflation and how these monetary policies within these DePIN networks scale. And in most cases, they have a huge problem that they're just building because at some point you need to have equilibrium back to either under whatever the equity cost is for what the yield might be, but they're in a catch-22 because once you've inflated so much into the market, you're almost forced to keep some perpetual amount at an ongoing rate. You can effectively remove quite a bit of that by having some controlled interest rate that allows for a better economic model within these DePINs, which I think is really interesting.
Yeah, and the quick math is the cost of tokens is effectively the cost of equity plus the cost of debt. For us, our interest rates are probably going to be closer to 15 to 25%. And that's always going to be cheaper than a 6-month payback period, which is by definition 200% APR, which is also declining because the price always goes down after launch.
Right.
So just like and at the same time, the DePIN protocols absolutely love it because people are taking out debt to buy expensive hardware. And that's how they make money. And at the same time, if you buy an asset and you wait 6 months to buy another hardware, that's actually what happens among DePIN operators. You're like, yeah, I got 100% back after 6 months. What am I going to do? They're not going to just pocket it. They almost never do. They always buy more.
Yeah.
And that is so slow. It's just like you have to wait 6 months to get more users. Like, why don't you on day one, 100K, you bought 100K hardware, borrow 75K against it. Then you buy 75K hardware within the same minute, right? You can just loop it like that many times. So you suddenly have 4x of the supply from day zero. So DePIN protocols, I would argue, will have a very powerful tool soon. And that's one of the things that we want to really support.
I love that. Between the capital efficiencies and just everything else that you're talking about, it's really fascinating. On that point, was there anything else that we didn't get a chance to cover that you think is relevant for people to understand? Obviously, there's a lot that goes into what you're doing on the financial technical side that is really important for people to understand. But was there anything else we didn't get a chance to cover that you want to bring up?
Just trying to go through like our deck pretty much. The bridge and education is going to be quite a long process because DeFi people have to understand DePIN and vice versa. I think DePIN people understanding DeFi is actually a lot easier than DeFi people getting comfortable with DePIN economics just because it's such high diversity. The only thing I'll say is DeFi is a money markets by definition. I think a lot of people call it DeFi money markets. That's because you're in the business of doing loans against money. That's really what money markets is. Like that's why Aave is called money markets because you're giving loans against fungible stuff.
Yeah.
DePIN plus DeFi is the first time you've given loan against productive stuff, not money. Money by definition is not productive. It's prioritizing liquidity. So I would say this era of InfraFi is really the first capital markets because you're giving loans against capital means something productive. You're not giving loans against money. Hardware is not money. It's by definition productive. And InfraFi could, and if you work at a bank, a capital markets is 95% of the bank. I'm hoping that really this is the start of a real capital markets in DeFi or in crypto. So I just want to say I'm pretty excited about that because I think this is true finance, not money markets, not giving loans against Apple stock. My favorite joke is like, when I worked at the bank, if someone told me they're giving loans against like commercial paper, I'm like, Sorry, I wouldn't invite them to drinks after. It's because they're called back office for a reason. So yeah, just want to say that as hey, we've developed money markets, and we're recreating capital markets in a sense.
I love it. I think that's an incredible way to end this out. David, where can people stay up to date with everything that you're building, either on a personal note or at the company level? Where can folks find you?
You can go to our website, which is www.usd.ai. We paid a pretty dime for that domain name, but also
I was going to ask.
we also have our Twitter, which is USD.AI_official. And we're targeting probably late April to early May launch date, depending on our audit progress. But that's where they can keep up to date with our progress. And we'll have more research reports coming soon with some people that have been trying to understand what we're doing. I guess education is probably more important before they do anything with their protocol and get comfortable with the risk.
Yeah, I think that's great. We'll definitely have all that linked below. Certainly go follow USD.AI on Twitter X. Go follow David as well. He's got some great takes if you're interested in learning more about the space. David, want to thank you again for coming on to chat. I think this is a super, super fascinating topic in general, but it's also really important for kind of driving the next evolution. So wanted to thank you again. But we will wrap it up here. Definitely go check them out, and we will see everyone on the next one. Take care.